For decades, silver has lived in gold's shadow. It was the metal investors joked about, the asset many believed would never truly break free, the commodity that repeatedly surged, collapsed, and disappointed an entire generation of traders. But now, something unusual is happening. Not just another rally. Not just another speculative spike. What some market veterans are now describing is the possible beginning of a structural transformation in the global precious metals market. One that could redefine silver's role in finance, manufacturing, and investor psychology for years to come. Tonight, we're breaking down the explosive thesis behind the latest silver forecasts shaking up Wall Street, why industrial demand is rewriting the rules of the market, and why a growing number of analysts believe the current move may only represent the early stages of something much larger. Because if the data behind this trend is accurate, silver may no longer be behaving like the forgotten metal of the past. It may be transitioning into one of the most strategically important assets of the decade. Welcome back to the channel. This is your deep dive economic briefing, and today we're unpacking one of the most controversial and fascinating stories developing in global commodities right now. Let's begin with the biggest question. Why are silver forecasts suddenly becoming so aggressive? To understand that, we need to step back and examine what has changed in the market structure itself. For nearly half a century, silver was trapped inside a psychological cage. Every major rally eventually hit resistance. Every breakout attempt faded. The metal developed a reputation for failing precisely when investors became most optimistic. That pattern created a powerful mindset across the financial world. Silver became viewed as unreliable, volatile, speculative, a market dominated by short-term excitement rather than long-term institutional conviction. But according to several macro analysts, the market may have crossed a threshold that changes that entire narrative. Here's why. When an asset spends decades trapped below a specific price zone, that level becomes more than just technical resistance. It becomes psychological conditioning. Traders begin to believe the ceiling is permanent. Institutions stop preparing for major upside scenarios. Retail investors lose confidence. And eventually, markets become positioned for stagnation instead of expansion. That's exactly what happened with silver. For years, analysts referenced previous historic peaks as proof that the metal simply could not sustain higher prices. But recent price action challenged that assumption in a major way. Once silver began pushing through long-established resistance areas, analysts started comparing the move to historical commodity supercycles. And that comparison matters, because commodity markets behave differently from stocks. When supply shortages collide with structural demand growth, price increases can become nonlinear. In other words, prices don't always rise gradually. Sometimes they explode. We've seen versions of this throughout financial history. Oil shocks, natural gas squeezes, uranium rallies, rare earth shortages. And in many cases, the most dramatic gains happened only after years of sideways consolidation lulled investors into complacency. That's the backdrop now surrounding silver. But there's another layer making this story even more significant. Unlike previous silver rallies driven mainly by investor speculation, today's market is increasingly tied to industrial necessity. And that changes everything. Silver is no longer just a monetary metal. It's now deeply connected to the global technology economy. Think about the modern world for a moment. Solar panels, electric vehicles, advanced medical devices, military systems, semiconductors, high-efficiency electronics, artificial intelligence infrastructure. All of these sectors require silver because of its unmatched conductivity and industrial properties. That means silver demand is no longer dependent solely on investor enthusiasm. Industrial consumption is creating a separate demand engine entirely. And according to multiple industry reports, that engine is accelerating. Global solar deployment alone has become a major silver consumption driver. As countries race toward renewable energy targets, photovoltaic manufacturing continues expanding at enormous scale. Every major green energy initiative increases pressure on silver supply chains. Then add electric vehicles, Modern EV systems require significantly more silver than traditional automobiles because of advanced electronics and power management systems. Now layer on military technology. Precision systems, communications infrastructure, aerospace components, and defense electronics all rely heavily on silver-based materials. This is where the conversation becomes serious, because unlike paper assets, physical silver must actually exist to satisfy industrial demand. And supply growth has not kept pace. That imbalance is becoming increasingly difficult for the market to ignore. Mining expansion is slow. Permitting takes years. Environmental regulations are tightening globally. Ore grades in several major mining regions have declined. And many silver mines are not pure silver operations at all. A large percentage of global silver production comes as a byproduct from mining other metals like copper, zinc, and lead. That means silver supply cannot simply be ramped up overnight in response to higher prices. This creates a dangerous setup during periods of rising demand. If industrial consumption keeps climbing while physical supply struggles to expand, the market eventually reaches a pressure point. And historically, markets resolve pressure through price. That's one reason analysts are paying close attention to persistent supply deficits appearing in recent industry data. For multiple consecutive years, silver demand has reportedly exceeded annual supply. Inventories accumulated over decades are gradually being drawn down to fill the gap. Now, deficits alone do not guarantee explosive price action. But when deficits appear alongside technical breakouts and rising investor interest, the environment becomes much more volatile. And that brings us to the investment side of the story. Why are institutional traders suddenly paying attention again? The answer may lie in macroeconomics. Over the past several years, the global financial system has entered a period of increasing uncertainty. Inflation concerns, massive sovereign debt expansion, geopolitical instability, currency devaluation fears, banking system stress, central bank intervention. All of these factors tend to increase interest in hard assets. Historically, precious metals perform best when confidence in financial stability begins weakening. Gold usually moves first because institutions treat it as a reserve asset. Silver often follows later, but with greater volatility. And that volatility is exactly why some analysts believe silver could outperform gold during specific phases of the cycle. Here's the logic. Silver is a much smaller market than gold. That means capital inflows have a disproportionately large impact on price. If institutional money rotates aggressively into silver, relatively small allocations can create enormous market moves. This has happened before. During previous precious metal cycles, silver dramatically outperformed gold during the later acceleration stages. The reason is partly psychological. Once investors begin fearing they missed gold's move, they often seek cheaper alternatives with higher upside potential. Silver becomes the momentum trade. That speculative energy can create rapid repricing events. Now let's talk about one of the most important indicators analysts are monitoring, the gold-to-silver relationship. Historically, the relationship between these metals fluctuates in cycles. At certain moments, silver becomes historically undervalued relative to gold. At other moments, silver dramatically outperforms. Analysts studying previous precious metals bull markets noticed that silver often experiences its strongest advances during periods when the ratio begins compressing rapidly. In plain English, silver starts rising faster than gold. That phase tends to attract enormous attention because it signals speculative momentum entering the sector. And according to some market observers, recent price behavior may suggest the early stages of that transition. But there's another dimension to this discussion that retail investors often overlook. Mining equities. Historically, silver mining companies can behave like leveraged versions of the metal itself. Why? Because mining profitability expands exponentially as prices rise. Imagine a mining company producing silver at a fixed operational cost. If silver prices rise modestly, profit margins improve. But if silver prices surge dramatically while production costs remain relatively stable, earnings can explode. That's why mining stocks often become some of the highest performing assets during commodity supercycles. However, they also carry additional risks: political instability, operational failures, management issues, environmental liabilities, production disruptions. So while mining stocks offer upside potential, they are not identical to holding physical metal. Still, professional investors closely watch mining performance because it sometimes acts as an early signal for broader sector momentum. When institutional capital aggressively enters mining equities, analysts interpret it as confidence in future metal prices. And that's exactly why recent activity in the mining sector has drawn attention. Now, one of the most fascinating aspects of this silver debate is the psychological divide between believers and skeptics. Critics argue that extreme price forecasts are unrealistic. They point to silver's history of volatility and failed breakouts. They warn that speculative enthusiasm can distort rational expectations. And to be fair, commodity markets are notorious for dramatic booms and painful collapses. But supporters of the bullish thesis argue that today's environment is fundamentally different from previous cycles. They believe the combination of industrial demand, supply constraints, inflationary pressure, and monetary uncertainty creates conditions not seen in generations. Some even compare the current environment to the early stages of historic commodity supercycles that initially appeared impossible before eventually reshaping entire industries. So what happens next? There are several key developments. Investors are watching closely. First, sustained price stability at elevated levels. In commodity markets, holding gains can sometimes matter more than achieving them. If silver continues consolidating above previous resistance zones, analysts may interpret that as structural strength rather than speculative excess. Second, industrial demand trends. Any evidence of accelerating solar deployment, EV production growth, or semiconductor expansion could strengthen the long-term consumption thesis. Third, central bank policy. Interest rates remain a major driver for precious metals. Lower real interest rates historically support gold and silver by reducing the opportunity cost of holding non-yielding assets. Fourth, geopolitical instability. Periods of financial uncertainty often push investors towards safe haven assets. And finally, physical supply data. If supply deficits deepen further, the pressure on the market could intensify. Now here's where things become especially interesting. Some analysts believe silver's importance may extend far beyond investment markets altogether. Why? Because silver sits at the intersection of two massive global transformations: the energy transition and technological expansion. That means silver is no longer merely a speculative asset. It's increasingly becoming strategic infrastructure material. Countries pursuing renewable energy targets need it. Defense systems rely on it. Advanced manufacturing consumes it. Artificial intelligence infrastructure indirectly depends on it through high-performance electronics. In other words, silver may be evolving from a cyclical commodity into a strategic industrial resource. And if that shift continues, traditional valuation models may need reconsideration. That possibility is one reason long-term investors are paying such close attention. Not because they expect a straight line upward. Commodity markets never move that way, but because structural demand changes can create multi-year trends far larger than most participants initially expect. Now let's address the biggest question everyone is asking. Could silver actually reach the extreme price targets now circulating online? The honest answer is that nobody knows with certainty. Markets are influenced by countless variables. Economic recessions can reduce industrial demand. Central bank tightening can pressure precious metals. Speculative bubbles can collapse rapidly. Unexpected supply increases can alter pricing dynamics. But what analysts are really debating is not whether volatility will occur. Volatility is guaranteed. The real debate is whether the market has entered the early stages of a structural repricing cycle. And that distinction matters, because structural cycles tend to last longer and move further than most investors imagine during the early phases. History repeatedly shows that transformative market moves often appear irrational before they become obvious in hindsight. Very few people believed oil could surge during energy crises until it happened. Very few believed technology stocks would dominate global markets decades ago. And very few believed certain commodities could multiply several times over before supply shortages forced repricing. That doesn't guarantee silver follows the same path. But it explains why serious analysts are studying the market so closely. At minimum, silver has re-entered the center of the global macroeconomic conversation. And that alone represents a major shift compared to previous years. As we move deeper into this economic cycle, one thing is becoming increasingly clear. The battle over silver is no longer just about charts or speculation. It's about energy, technology, monetary policy, industrial growth, global supply chains, and investor confidence in the future financial system itself. Whether the most aggressive forecasts eventually prove accurate or not, the forces driving this conversation are real. And markets tend to pay attention when multiple structural trends begin converging simultaneously. So the coming months could become critically important. Will silver stabilize and continue climbing? Will industrial shortages intensify? Will investors flood into hard assets as uncertainty rises? Or will the market once again fail to sustain momentum? Those answers may define not only the future of silver, but the next phase of the broader commodity cycle itself. And if this story continues accelerating, we could be witnessing the beginning of one of the most closely watched precious metals markets in modern history. If you enjoyed this breakdown, make sure to subscribe and turn on notifications for more deep-dive financial analysis, macroeconomic reporting, and commodity market coverage. And now we want to hear from you. Do you believe silver is entering a historic supercycle? Or is this another temporary surge destined to fade? Drop your thoughts in the comments below. We'll be watching this story very closely, and we'll see you in the next report.